Hey everyone, Ryan Bolton here. I am a mortgage nerd with Patriot Home Mortgage. I lend in the states of Utah and Nevada. Love an opportunity to work with you on purchasing or refinancing a home. We also offer lines of credit. So if you're looking to keep your rate on your existing first mortgage, but have a lot of equity you want to tap into to maybe do some remodeling or pay off debts or whatever else, love an opportunity to work with you on any financing needs you may have when it comes to home ownership. Now, look, I know there's a lot of talk out there about interest rates, home prices, and people waiting to buy until they see interest rates go down. But here's some of my thoughts. Sure, interest rates are higher than what they have been. Historically, they're actually still in the lower range, maybe a little above what the average has been over the last 7 years. But what would happen, do you think, if interest rates do drop? Let's say we drop from somewhere in the sevens, low eights into the sixes, or even into the upper fives. What do you think is going to happen? There's going to be this huge pent up demand that's going to try to gobble up whatever supply is out there. And in most areas, most places in the country, supply is low. We're still in what's called a seller's market where there's still less inventory than demand. Has demand slowed? Absolutely. But we needed it to. We had home prices that were priced at 350, 450,000 that people were offering 50 and 70 and $100,000 more than asking price because rates were so low and inventory was also so low that people were just jumping in to take advantage of the market. I think you're going to see something very similar if interest rates do drop, because then you're going to see this pent up demand that's just going to outpace any kind of supply. So I think it's still better to say, okay, what can I afford? What is my monthly payment? And what will that afford me? That's what you need to shop for. Then, if interest rates do drop, great, you can refinance and lower that payment. But at least you've locked in the ceiling of what that payment's going to be, and you can only work it down if the situation gets better. And if rates do happen to get worse, well, you're ahead of the curve. If they get better, appreciation will go up. You'll see home prices increase. So it's better to do it now. I can't tell you how many times in my career over the last 20 years that I've seen this saying play true. The best time to buy real estate. You ready for this? Write this down. The best time to buy real estate was 6 months ago. The second best time is right now. I know so few people that regret buying a home, but I know a lot of people that regret not buying a home. Like, oh, I should have bought 2 years ago. I should have bought a year ago. I should have done this and should have done that. Even after people went through '08, there's very few people that really regretted buying a home. And that was one of the trickiest times to buy a house. But even then, it bounced back. Even then, there was appreciation. Even then, there was benefits of owning a home. Now, is it a short-term investment? No, it's never been designed to be a short-term. So we'll see these bubbles in the market where you can just turn and burn the houses and make a bunch of money. That's not really how they're designed. And when that does happen, you know there's a slowdown that's coming. But right now is a perfect time to buy because you do have sellers that are more motivated if they're trying to sell during this market. And there's a lot of pent up demand. I'm telling you, that faucet is going to fly open if interest rates drop. So I think it's a good time to buy. Find out what you qualify for. Go out and find the payment that fits that budget or the home that fits that payment. Sure, maybe 2,500 bucks doesn't afford what it used to, but it still is something out there. And then you'll be able to get into that home, maybe keep it for a few years, turn that one into a rental or upgrade after that. So I see too many people sitting on the sidelines, and I know that there's some uncertainty out there, but that's where I can help at least show you what you qualify for today, what you need to do to qualify for more, and be ready to take advantage of when the house hits the market, regardless of the interest rate environment. Sure, that's something to consider, but I'm telling you, supply and demand affects prices a lot more than interest rates. The interest rates are designed to just kind of slow it down, just give supply a chance to catch up, but we're not really seeing supply increase because demand is slowed so much and there's just a lot of wait and see going on out there. But I'm telling you what, if you can afford a home and you want to lock in your payment, you don't want your rent keep going up, and you want to move into this wonderful area of Southern Utah, find out what you qualify for, find out what payment it's going to be, and then find the home that meets that budget. All right, let's answer some other questions today. I like to keep these videos to about 20 minutes or less. So I found a couple good ones here, and I wanted to do this real quick. Oh, let's see. This is along the lines of that intro, kind of a long soapboxy intro, but here we go. When interest rates go up, does the housing prices go down? No. It depends on supply and demand a lot more than interest rates. In fact, if you look at some of the biggest recessions, we actually saw home prices go up because home prices and buying a home can be a hedge against inflation because you can lock in your payment. So it's something where it's better than other types of debts and other types of loans out there. Have there been times where interest rates have gone up and home prices have gone down? Sure. But generally speaking, interest rates don't play as big of a role as supply and demand, just on anything. Supply and demand is going to play a way bigger role in the price of anything, whether it's a home, car, candy bar, chicken. I heard the price of chicken is going to be going up like crazy or something because supply is slower than demand. And those things always are ebbing and flowing with supply and demand. Interest rates can help maybe curb demand a little bit to let supply catch up, but you're going to see that play a bigger role than interest rates. All right, let's see. How much have mortgage rates dropped, and what impact does that have on different types of loans? So they've dropped a little bit. Yeah, there's been a lot of news of interest rates dropping, so that's been some good news there. But how does it impact different types of loans? So the loan programs are the program that is available to get the loan. The rate's more dictated by the market. So just because rates drop doesn't mean all of a sudden a new program is created because rates are lower. They're still just the same programs as far as guidelines. There's the payment to get the loan is based on the interest rate. So it's not like, okay, as soon as rates hit 6%, this new loan program pops up. I mean, new loan programs pop up to help supply and demand, and investors will be creative on how to help more home buyers to fit a need in the marketplace. That's just going to be capitalism. They're just going to find ways to say, okay, who can't we say a loan to, and why can't we say yes to that borrower when this debt ratios are too high, or student loans are an issue, or credit scores. We got to look at maybe softening credit score requirement or something like that. That's what you're going to see. Loan programs are just going to fit a need of the marketplace. Where's the demand? Where's the demand for home loans? That's what the market's going to try to fill that need. So I don't think, yeah, interest rates don't affect the type of loans as much. It's just guidelines affect the type of loans more than anything. Let's see. Do you know that you do not need perfect credit to buy a home? Very true. But the better the credit, the better the rates and terms in most cases. So it is something where I have a lot of people say, can I get a home loan with bad credit? Sure. Can you get a better loan with better credit? Sure. So why is the credit bad is the first question I'll ask when somebody says, I have low credit or I have credit issues. Because if we work on those, we can get you into the next tier, which gets you better rates, better terms, better mortgage insurance, maybe less money down. So working with the credit is a better use of the time than just finding a loan that fits the credit today. That's where having more time to do a pre-approval, getting your ducks in a row a little early can make a huge difference on the type of loans you have. Having more time is a hill I'm going to die on. Get your pre-approval started early. I cannot tell you how many times if we just had 30 more days to work with a client, we could have done something with their credit that would have got them a better loan. That's just how it works. That's one of the major factors on your interest rate is your credit score. Can you get the loan without it? Sure. Can you get a better loan with better credit? Absolutely. All right, let's see. We've got let's see. Let's go back and refresh the screen. There's always new questions popping up, which is great. What, if any, are the advantages of an interest only mortgage? Interest only mortgages are a benefit of just having a minimum payment for a certain amount of time, but they're designed to be short term loans. They're not designed to be a long term loan. So you'll see interest only loans on, say, private money, maybe construction loans. Some of these loans where it's just kind of a bridge loan, it's a temporary loan until a more permanent loan can take its place. So maybe it's a home you're not going to keep forever. I mean, if you look at an interest only payment for 2 years versus a principal and interest payment in 2 years, the amount going to principal is not that much anyway. It really isn't. So if you know it's a shorter term loan, maybe it's a loan that's going to roll into more of a permanent, or it's just a temporary thing because you're going to be selling, or it's going to turn into rental, or you're rehabbing. I mean, there's a lot of different reasons why you would do a loan, but interest only is just designed to kind of make a temporary payment until you get it more into a permanent loan. There isn't an interest only mortgage that's the whole life of the loan. A lot of times interest only loans are for a certain period. They can be for the first year, 5 years, 10 years. There's usually a window when it's interest only. Then whatever the balance is after that window will amortize with the years left. So you'll see kind of a window of when it's interest only. If you do pay the extra on an interest only loan, you can see increased principal reduction. So it is something where if you can pay the extra, do it. But it is something where most of the time people do an interest only loan because they're just looking for like a 2 year window, maybe for tax returns on a business. Maybe they just started on a business or something like that. Maybe the home's a construction loan or a rehab, and they know that their income or their situation is going to be different to where then they can roll that loan or sell the property within that window, within that safety window. So that's why those loans can be attractive for the right borrower. I don't think they're for everybody. Absolutely not. Just like I don't think a 15-year term is for everybody. So it is something where it's part of sitting down with the client and figuring out what their long and short term needs might be. All right, let's see. Let's see. How are rising mortgage rates and limited inventory affecting home prices? That's where you're seeing home prices are more resilient than interest rates in the sense of supply and demand. So we've already kind of talked about that today in this video. A lot of questions about that today because I think that's really in the news a lot. As interest rates are talked about and as they do come down, people are looking at what's out there and there's just not a lot to choose from. Because if you're a homeowner right now that wants to upgrade, and let's say you've got 4% on your interest rate, it's pretty hard to go from 4% on a $300,000 loan jumping up to a $500,000 purchase price at 8%, let's say. But I think you're going to see when rates get closer to maybe 6, you're going to see a big pent up demand of buyers and sellers hit the market where supply just will not be able to catch up to that. There's a lot of pent up wait and see demand. And as soon as that hits, we're already seeing it. We saw rates go from 8 to 7.5, and all of a sudden I see all this news. Rates are going down, rates are going down, rates still 7.5%. What happens if they go to 6 something? Like if 6 is 6.99%, I think you'll see another wave of people that are like, okay, now I'm ready to go. Now I want to upgrade. Now I want to sell my house. Now I want to buy something else. I think if you see a 5 in front of that number, if you can get down to that point, you'll see a really big increase in demand, even though supply won't catch up to it. So I have people say, well, I'm going to wait to see if rates hit 5%. Sure, you can time it. Maybe you'll get lucky. But what's going to happen is the home you want or that supply again won't be available. And all of a sudden you'll be in a bidding war. You'll see a house pop up for 400,000 that you really like in the neighborhood and all that. And you'll have 10 buyers for it again. So what's going to happen? Overbidding. They're going to price it more. They're going to come up with contingency. You might miss the window where if you buy now at that price and the rate, if rates get better, you can refinance. And you'll take advantage of any appreciation that happens during that time. So homeowners win in the long run. What you need to find out right now is what your budget will allow you to buy and shop for that home. Don't shop the interest rate. The interest rate's going to be just something you can't control. But what you can control is I can afford X amount per month, 2,500 bucks, 33,000 a month, whatever that dollar amount is, get pre-approved for that amount and then go find a home that fits that. And then as you own the home, it will either get better on the payment because rates will get down or appreciation will go up and the home will be worth more. But now you have a locked in payment as long as you have that mortgage. You'll have the pride of home ownership. You'll have tax benefits you don't have. I'm telling you what, I've been doing this for since 1999. I closed my first mortgage loan in 1999. I've owned a lot of real estate. I still have a lot of real estate. I'm a big believer in real estate. As long as you know it's designed to be longer term. It's never been designed to be something that's just quick and easy and turn the property. Those times happen, but it's really crazy lucky to get timed up with that. When most of the time, if you're looking at it as a long term, you're going to be better off in the long run. Let's see how we doing on time. My little timer is right underneath my right underneath my little window here. Okay. And I just try to do these live. I'm not pre-screening them. I'm just going through it, just off the cuff, and I get talking quick. And I like what I do for a living. Have liked it for years, and that's why I'm still doing it. You see a lot of people exiting the business, whether they're real estate agents with all the stuff they're dealing with, or mortgage people. Mortgage applications are down, so there's just a little less fish in the sea, so to speak, for the mortgage people. But I like doing this. I like helping people figure out what they qualify for. I like going through the payments and the nuances of underwriting guidelines. And that's what I do and what I'm excited to do. And I want to help you. If you want to buy a home in Utah, Nevada, I want to earn your business. I want to show you the different loan programs, the pluses and minuses, the benefits and disadvantages of whatever loan programs you qualify for, and get you into a home. Because I tell you what, people regret not buying a home way more often than they regret buying a house. Way more. Like infinitely more than people that regret buying a home. Does that make sense? I hope that makes sense. But I'm just a big believer in real estate. Is it possible to set up a 30-year mortgage where extra payments lower the monthly mortgage? No. So once the 30-year fix is amortized over that time frame, you don't see a lot of loans where if you pay a bunch extra, the payment goes down. It just really reduces the term. A lot more goes right to principal. So you don't have a lot of loans out there unless it's like a line of credit. I mean, there's some that are out there, but typically a first mortgage on a 30-year amortization, if you put 50 grand down, maybe you sell something or get an inheritance or bonus or something, you just put it towards the loan. It doesn't re-amortize the loan to a lower balance and the remaining term. A lot of times it just reduces the term or goes right to principal. That's how loans will work. Now there might be some out there that do it, but generally that's just not how mortgages work, especially on a first mortgage. If someone has defaulted on their mortgage, can they get another one? So I'm assuming another mortgage or home after some time has passed. Yes. There is waiting periods on certain mortgage programs, anywhere between 2 to 4 years from a foreclosure. It usually goes off the date the property is sold, though. So you could move out, you got the 90-day waiting period, you go through kind of the process, they go to finally sell the home. So that when that clock starts can be a little tricky to pin down. But generally, yes, there is waiting periods after you own it. Usually it's that 3 to 4 year mark is where most programs open up. There are some that open up at 2 years, but it is something where you're going to have to recover from not making a mortgage payment. I mean, once you miss that mortgage payment and start to default to the point where you walk away from the home and the liability, there's going to be some time before another lender is going to just say, "Yeah, we'll do another loan for you," especially if you're not putting any money down or something like that where you have limited down payment. So it really just trashes the credit. And if you can save it, if you can work out something, either sell it or work something out with the lender, you're better off than just completely walking away. What are the rules of buying a home from a parent for less money? That's a great question. So, whatever the purchase price is what the loan's based on, or appraised value, whichever's less. So, for easy numbers, let's say it's worth 300,000, but the parents say, "Hey, we'll sell it to you for 200,000. That's what we owe. We want to help you out, and part of inheritance or whatever. We'll discount it and help you into the house." So one of the best ways to do that is actually sell the price of the home for more and have the parents gift the difference. That way you're able to do, more of a better loan. You can have less mortgage insurance potentially. You don't have to come up with the down payment. You can build in closing costs, all those types of stuff. So I've worked with a ton of families where we help them structure how the purchase is done. So that way you are maximizing the equity that's in the home or the difference between the asking price of the parents need or grandparents or whoever's involved and the actual market value of the home. So you can actually gift the difference. It's far better than selling the home for 200,000 and then the son or daughter has to come up with the down payment. They still have mortgage insurance even though there's all this equity in the home. So if it's a family situation, you can make that work. So if you're in that situation where you have a son or daughter who wants to buy the home and you want to maximize the best loan for you and for your kids, we need to talk because there's ways to structure it correctly. Now, as a licensed loan officer, I can't negotiate with you and your son. I can't do the negotiation with him, but I can kind of show you how to structure it. Then you guys can kind of work that out on how the contracts read and all those types of things. But at least can show you kind of the concept, and then we can show you how to implement it. I just can't represent, say, the parents and negotiate with the son or or the daughter or vice versa. That would take a licensed real estate agent to do that. But there is there is some nuance when it's a family selling to a family. There's assumable. Maybe the loan that you currently have is an assumable loan that the kids can just take over that payment, take over that interest rate. So if you're in a situation, I'd love to work with you and your family to show you how to structure that to just maximize the loan for the seller and the buyer, in this case, the family that is involved. I've done many of those in my career. Let's see how we doing on time. Again, my little clock is just right underneath my webcam here. So I just have to be able to click on the right screen here. Okay, I try to keep these about 20 minutes. Let's see if we can squeeze one more in here. What happens if too many homeowners leave an HOA community? That can be interesting there because the HOA payment is going to maintain the things within the HOA. So most HOAs have to have a reserve to cover if there's a major expense that hits the community. So say the pump on the pool goes out, or the tennis court has to be resurfaced, or the roof on the condominium project has to be fixed. So HOAs are supposed to build in as part of that payment a reserve for those things. But if you get too many people leaving, they're not replenishing the reserve and covering the expenses. You can start seeing some issues where the new buyers actually have to kind of pay more. They have to change that expense over the whole community. So that's pretty rare where it gets that desperate, unless it's a very small HOA. And let's say there's only 10 people or 10 homes in the HOA and five of them sell or go into foreclosure. We saw that a lot in '08, where all of a sudden the reserves were really getting tapped into to cover maybe the monthly reoccurring expenses. But almost every HOA, I think Utah's, there's actually some laws, you have to build in a reserve that covers these one-time big expenses, or if there is a really drop in receiving the revenue. But it's rare, but it definitely can happen within HOAs. All right, let's see. I think that pushes us over 20. Ooh, we're almost at 20 minutes. All right, let's see if we can throw in one more here. Got to find a good one to end on. Who can avoid the impact of high mortgage rates? uh, Define high. What are you trying to avoid? I mean, you can avoid the high interest rates if you already got your mortgage. So it doesn't really affect you. It really just affects the new buyers and the sellers. And I really do think we've hit kind of a cap. I think there's a wait and see. I mean, yes, rates can go up even further, but I think you're starting to see the Fed slow down in rates. And kind of what they were trying to do to flush out inflation, not let it get really, really crazy, is starting to get curbed. So the need to push rates up any higher is probably slowed down a little bit. And I think there's actually more pressure to maybe move rates down over the coming year. But I think it's going to be wait and see. There's just a lot of wait and see going on right now. So I probably stay with that answer for now. One more. Come on, we can find one more. Let's go to a different screen here. Let's go to a different topic. Let's see. How do lower mortgage rates affect current homeowners and potential buyers? Current, it doesn't really affect current all that much unless the rate is available today is lower than the rate they have. Then you would see refinances. We're not really seeing that the case. In most cases, a high percentage of cases, current mortgage rates that are available are higher than what the rates that most people have. That's why you're not seeing refinancing. It's very rare that you're seeing any kind of refinance unless there's a lot of other debt they're paying off or there's a divorce situation where they have to remove a spouse, something along those lines. But the traditional refinance usually is where rates, they're at 8%, rates go to 7%. They want to take advantage of the lower rate. So it really doesn't affect current homeowners that much. They've already locked in their payment. Potential home buyers is a different story. They're buying in at that today's rate. But again, I think there's more pressure to move rates down. So I think it's something where you just find out what you qualify for, find out what homes fit that budget, and buy. If you're capable of buying, if you have the finances to do it, if you have the credit score, all the things required to buy a house, I would buy. And then if rates get better, you can take advantage of it. But if rates do get better, guess what's going to happen? Your appreciation is going to go up even faster. So it's a win-win to buy. It really is. It's longer term. Sure. It may take a little longer for rates to either drop where you can refinance or where that appreciation will go up. But during that time, you've got a locked in payment where your rent's not going to be locked in. And people often complain about interest rates and like, well, what's your rate on your rental? Well, I saw one report 110% because you're missing out on appreciation, missing out on tax benefits, and 100% of your payments going to somebody else's mortgage. So it's funny how people complain about high interest rates when they're paying 110% right now. So it, it really, what's more important is what payment can you qualify for? That's the home you should go find. So I think that's enough time on today's video. Yep, we're out of time. So I love the chance to work with you. If you're looking to buy in Utah, Nevada, I'd love to work with you. But if you're not, I can still answer any questions you have. I really enjoy what I do for a living, and I want to help you into home ownership. There's nothing like it. Homeowners win in the long run. You get to have pets. I mean, how many rentals can you not have pets? And I tell you what, it's one of the great joys is having my pets. It really is. You get to customize. You get to have some space of your own. You usually get a little more distance from your neighbors right above or right to the side of you. You get a yard, you get a garage. There's just so many things you get with home ownership, and you get the appreciation and tax benefits with home ownership. So they win in the long run. Buy a home. Find out what you qualify for. Let's get you pre-approved. Find out what loans programs you qualify for, and let's go find a home that fits that budget. It, it's better to be a homeowner. We are just beating a dead horse at this point. So I love a chance to work with you. If you're looking to buy in Utah, Nevada, check out my website, ryanbolton.com, and we'll see you on the next video. Have a wonderful day.